If you're between 60 and 75, with somewhere around $1 to $2 million saved across your retirement accounts, this is the most important 15 minutes you'll spend on your money this week. Because there's a quiet mistake hiding in how most Americans take money out of those accounts. It isn't about what you invested in, it's about the order you withdraw. And for a couple with a seven-figure balance, getting that order wrong can hand the IRS more than $100,000 they never had to pay. Here at the Retirement Desk, we walk through this the honest way. Real numbers, no sales pitch. By the end of this video, you'll know exactly which account to draw from, first, second, and last, and how to check it against your own situation. So let's be clear about who this is for. You've done the hard part. You spent 30 or 40 years saving, and now you have money in more than one kind of account. The question is no longer how to save, it's how to spend it down without overpaying tax. And before we go any further, one important note. This is educational content only, not financial, tax, legal, or investment advice. Tax rules change, and every household is different. Please confirm any figure you hear today at irs.gov or with a licensed fiduciary advisor before you act on it. Here's the cost of getting this wrong. Picture a hypothetical couple who saved carefully their whole lives, and then in their mid-70s watched nearly a third of a year's withdrawal vanish to a tax bill that a different order of withdrawals would have largely avoided. Same savings, same spending, just a different sequence. That's what's on the table. Today, we'll cover 4 mistakes. First, how the 3 types of accounts are really taxed. Second, the popular rule that quietly backfires. Third, the low tax window most retirees waste. And then the fourth one, the mistake most people never even see coming. The first mistake happens before you withdraw a single dollar. Most people look at their statements and think, I have $1.5 million. But the IRS doesn't see one pot. It sees 3, and it taxes each one completely differently. The first is your taxable account, a regular brokerage or savings account. You already paid tax on the money that went in. When you sell an investment, you owe tax only on the growth, the capital gain. And long-term capital gains get their own rates, 0%, 15%, or 20%. Often lower than the rates on a paycheck. The second is your tax-deferred account, a traditional 401k, a traditional IRA, a 403b. You got a tax deduction when the money went in, so the IRS hasn't been paid yet. Every single dollar you withdraw is taxed as ordinary income, the same rates as a salary. The third is your Roth, a Roth IRA or Roth 401k. You paid the tax up front. Qualified withdrawals come out completely tax-free. And a Roth IRA has no required withdrawals during your lifetime. Consider a hypothetical retiree who believes she has $1.5 million to spend. She doesn't, not really. She has an ordinary income bucket, a capital gains bucket, and a tax-free bucket, and each one is worth a different amount after tax. Fidelity lays out this exact 3-bucket framework in its retirement guidance. Before you can choose the right order, you have to see that you're not choosing between accounts. You're choosing between 3 different tax bills. Here's the rule almost everyone has heard. Spend your taxable account first, then your tax-deferred account, and leave the Roth for last. And there's real logic to it. It lets your sheltered accounts keep growing untouched for as long as possible. But followed blindly, it has a flaw. While you're living off the brokerage account in your 60s, that traditional IRA isn't sitting still. It's compounding, and the IRS will not let it grow forever. At age 73, required minimum distributions begin. The government forces you to pull a set percentage out every year, whether you need the money or not, and every dollar is taxed as ordinary income. Let's put numbers on it. Consider a hypothetical couple. Call them Robert and Margaret, both 65, both newly retired. Between them, they have $1.4 million in traditional IRAs and an old 401k, plus a brokerage account, and a smaller Roth. They follow the common advice exactly. Live on Social Security and the brokerage account and leave the IRA completely alone. Sensible on the surface. But that 1.4 million keeps growing. At a 5% return, after 8 years, it's about $2,068,000. The year Robert turns 73, the first RMD is due. And the required amount is the balance divided by an IRS life expectancy factor, which is 26.5 at age 73. $2,068,000 divided by 26.5 is roughly $78,000, forced out in a single year, taxed as ordinary income, stacked right on top of their Social Security. And it climbs every year after that. Fidelity illustrates this same pattern with its own hypothetical, a 62 yearly with money split across all 3 account types. Drawing one account at a time produced what Fidelity calls a tax bump. Little or no tax in the early years, then an abrupt jump to thousands of dollars a year once the traditional withdrawals kick in. In that illustration, total lifetime tax came to about $56,000. The simple order isn't wrong, but on autopilot, it quietly loads your single biggest tax bill into your 70s and 80s, exactly when a forced withdrawal lands on top of everything else. And the next mistake is where the real money is lost. Here's the opportunity most retirees walk straight past. The stretch between when your paycheck stops, often in your early or mid-60s, and when RMDs and full Social Security ramp up in your 70s is usually the lowest tax window of your entire life. And most people do nothing with it. In those years, your taxable income can be very low. That is your chance to voluntarily move money out of the traditional IRA, either by withdrawing it or by converting it to a Roth, and have it taxed at 10% or 12% now instead of 22% or more later. Look at how much room that bracket gives you. For 2026, a married couple filing jointly stays in the 12% bracket up to $100,800 of taxable income. Add the standard deduction for a couple who are both 65 or older. That's $32,200 plus an extra $1,650 for each spouse, about $35,500 in all. And they can take in roughly $136,000 of income and still have their last dollar taxed at just 12%. And under current law, for tax years 2025 through 2028, there's an additional senior deduction of up to $6,000 per person aged 65 or older, which gives many retirees even more low bracket room. So let's go back to Robert and Margaret, but change one thing. Instead of leaving the IRA untouched, each year from 65 to 72, they deliberately move a little under $90,000 out of the traditional IRA, keeping themselves comfortably inside that low bracket. Over those 8 years, that's roughly $700,000 shifted out of the ordinary income bucket at about a 12% rate. Had that same $700,000 instead come out later, in their 70s, piled on top of Social Security and RMDs, much of it would have been taxed at 22% or higher. That difference is about 10 cents on every dollar. On that piece alone, that's roughly $70,000 of federal tax avoided. And because their traditional balance at 73 is now far smaller, the forced RMDs are far smaller too, which keeps paying off for the rest of their lives. This isn't a fringe idea. Fidelity's own illustration found that a proportional approach, spreading withdrawals across all 3 account types instead of draining one at a time, cut total lifetime tax from about $56,000 to about $31,500. That's a reduction of more than 40%, and it made the money last about a year longer. The lesson: the gap years are a one-time window. Many advisors describe the strategy simply as filling up your low tax brackets while you still can. Here's the mistake most people never see, because it stays invisible until the bills arrive. A withdrawal from a traditional account doesn't just get taxed by itself. It raises your total income for the year, and two other things quietly key off that number. The first is your Social Security. Depending on your combined income, up to 85% of your Social Security benefit can become subject to federal income tax. A large RMD can drag more of that benefit into the taxable column. The second is your Medicare. Higher income retirees pay an income-related surcharge, known as IRMAA, on top of the standard Medicare Part B and Part D premiums. Cross an income threshold, even by a small amount, and your Medicare premiums rise for the year. Consider one more hypothetical retiree, Linda, age 74. Her RMD this year is larger than she planned for, but the withdrawal itself is only the first cost. It also pushes more of her Social Security into taxable territory, and it nudges her across an IRMAA threshold, raising her Medicare premiums for the following year. One withdrawal, three separate costs, only one of which she saw coming. This is the point most people get wrong. Sequencing your withdrawals to keep your income steady instead of very low and then suddenly spiking is what keeps these ripple costs small. The goal isn't the lowest tax in any single year. It's the lowest tax over your whole retirement. Now, here's the honest counterpoint, because this is not one-size-fits-all. The conventional taxable first order is not a mistake for everyone. If your tax-deferred balance is modest, well under a few $100,000, your RMDs may never be large enough to push you into a higher bracket at all. In that case, the simple order is perfectly fine, and simple has real value. And there's a real cost on the other side. Filling up brackets and doing Roth conversions means voluntarily paying tax now that you could have deferred. That's real money out of your pocket today. It only pays off if your tax rate later, or your heirs' rate, would have been higher. If tax law changes, or if you don't live as long as the projections assume, the math can tilt the other way. So please don't let any video, including this one, push you into converting large sums in a hurry. The right answer genuinely depends on your numbers, your balances, your other income, your health, your state, and your plans for whatever is left. This is a run-the-projection decision, not a rule-of-thumb decision. So here's what to carry away from today in 3 lines. 1. Your retirement money sits in 3 separate tax buckets: ordinary income, capital gains, and tax-free. And the order you draw them down changes your lifetime tax bill. 2. The default taxable first order can backfire because it lets your traditional IRA grow untouched until RMDs at 73 force out a large, fully taxed withdrawal all at once. 3. The lower income gap years before RMDs are the window to move money out at 10 or 12%. But whether to do it and how much depends entirely on your own numbers. And thank you, sincerely, for spending part of your day here at the Retirement Desk. We know retirement planning can feel heavy, and the simple fact that you're doing the homework already puts you ahead of most people your age. We're grateful you chose to do it with us. A reminder that this has been educational content only, not financial, tax, or legal advice. So please confirm your own figures at irs.gov or ssa.gov, or with a licensed fiduciary advisor before you act. If you found this useful, the video I'd point you to next is the RMD Rule 84% of retirees get wrong after age 73. Required minimum distributions are the exact event that triggers the tax bump we talked about today. That video walks through the rule itself and the costly errors people make once they reach 73. And if you'd like more of these walkthroughs, a quiet subscribe helps us keep making them. We'll see you at the next one.